Welcome to this deep dive. Today we are taking a massive stack of sources research papers on tax tech architecture, global regulatory briefings,
Yeah.
and, technical white papers on enterprise resource planning.
Oh, yeah. It is a pretty heavy stack.
Totally. And we are extracting the absolute core insights just for you, the learner. Now, our mission today, it might sound a bit dry at first glance. We are looking at global digital tax reporting and e-invoicing mandates.
Right, which is a topic that usually makes people immediately reach for a cup of coffee just to stay awake.
I mean, I don't blame them because there is a specific kind of dread reserved for, taking your car in for its mandatory emissions
Yeah, that's a
tests.
great way to look at it, yeah.
You aren't going in hoping the mechanic finds a way to make your engine run like 50% more efficiently. You just want the piece of paper, the sticker.
You just want to pass the test and leave.
Exactly.
Yeah.
And if the mechanic said, hey, while I'm doing this test, I can completely rewire your car to run on sunlight, you'd probably say, look, just give me the sticker.
Right, because you view the whole process as a burden. It's just a chore.
Yeah. And that is exactly how most global enterprise leaders look at the looming storm of global tax compliance.
Which is really a tragic missed opportunity, honestly, because it is a massive storm. The sources show a sweeping wave of digital reporting requirements rolling out literally right now.
Right, like the stuff in Europe.
Yeah, you have the European Union's VAT in the Digital Age Mandate, or VITA, as they call it.
VITA, right?
Plus, you have local mandates sweeping across Latin America and huge regulatory shifts happening throughout Asia, too.
It's everywhere.
It really is. And C-suite executives and boards of directors, they look at this transition to what the industry calls continuous transaction controls.
Wait, continuous transaction controls, what does that actually mean in practice?
So it basically means the government wants to see and approve your transactions the exact moment they happen, rather than, waiting for a tax return at the end of the year.
Wow, so they're just watching every invoice in real time.
Exactly. But when business leaders see this mandate, they just see this excruciating, highly disruptive IT burden.
A mandatory ticket to punch to avoid business interruptions and fines. Well, okay, let's unpack this. Because viewing this as just an IT and compliance burden completely misses what the sources suggest is, honestly, the greatest financial opportunity of the decade.
It really is.
We are going to explore how these regulatory forced hands are actually the key to unlocking incredible enterprise intelligence.
And that is the core argument we really need to establish here. Submitting an e-invoice to a government portal, it's not the end goal. It is merely a catalyst.
Okay, a catalyst for what?
The real objective is capturing a company's most valuable, yet often most scattered asset, transactional raw data.
So it's a total shift in perspective. You go from, I have to send this invoice to the government so I don't get penalized, to, I am organically capturing the absolute truth of my company's transactions at the microscopic level.
Right. And by fusing that raw e-invoicing data with your delivery orders, your incoming payments, and complex global tax rules, a business can build what is essentially a real-time compliance architecture.
Which transforms the whole concept of tax reporting.
Yeah, it takes it from a reactive, dreaded obligation into a strategic, data-driven capability. But to truly appreciate why capturing raw data is such a monumental game changer, we first have to understand why the traditional approach—
The legacy stuff.
Exactly, why the legacy tax tech market is fundamentally broken.
Broken and honestly actively harming global ERP ecosystems. I mean, if you are a CIO or a global head of tax today, and you go out to buy a global e-invoicing solution, you are stepping into a minefield of architectural compromises.
Oh, completely.
Let's look at how the mega vendors operate. The sources show that these massive legacy vendors, they love to boast about their extensive global coverage.
Oh, they do. They will tell you they cover 50 or 60 countries. But if you look under the hood at the mechanism of that coverage, that growth was largely fueled by aggressive corporate acquisitions over the last 2 decades.
So they basically just bought their way to global coverage.
Pretty much. They bought a small tech company in Spain to handle Spanish invoices, another one in Brazil for Brazilian taxes, and so on.
So it is absolutely not one seamless system.
Far from it. From an architectural standpoint, it results in this patchwork of disparate local platforms stitched together with digital duct tape.
Yikes.
Yeah, and when a multinational company relies on these fragmented ecosystems, they get trapped in what the industry calls a service mindset. You
Yeah.
aren't actually buying an autonomous technology platform that just works out of the box.
Right, you're subscribing to endless billable consulting hours. I mean, imagine Italy decides to change the specific XML format they require for their tax reporting.
Which happens all the time.
Exactly. The legacy vendor doesn't just push a clean update to your software. Because you are on this patched-together system, they have to send in consultants to manually remap the custom data fields in your specific system.
Which is incredibly expensive.
Yeah. That could mean hundreds of billable hours just to stay compliant with a single country's routine update.
Which brings us to the alternative that a lot of companies try out. They realize the mega vendors are, a consulting trap, so they turn to traditional EDI, electronic data interchange network providers.
Oh, I love the analogy for these EDI networks. I like to think of them as highly secure digital postmen.
Huh. Digital postman, I like that.
Make no mistake, they are very good at what they do. They get a highly sensitive digital envelope from point A to point B flawlessly. But like a postman, they are entirely document-centric.
Right, they don't care what's inside the envelope.
Exactly. They transport it, but they do not have the financial intelligence to open it, read the raw data inside, analyze the VAT implications, or, simulate cross-border rules.
And what's fascinating there is that divergence between transporting data and actually understanding it. A digital postman just provides the communication pipes. That is all.
Just the pipes.
Yeah, they completely lack the embedded tax advisory and technological intelligence you need for full-scale financial optimization. And that leads directly to what our sources identify as the most painful part of the legacy market, the pre-formatted trap.
Okay, so if the postman can't read the data, someone has to make sure the letter's written perfectly before it goes in the envelope. And that burden falls entirely on the company's internal IT team.
Yep. They essentially dictate that before you even transmit data to their platform, your IT department must extract it from your finance systems and transform it into highly complex, country-specific XML formats.
That sounds like a nightmare.
It is. These legacy vendors just refuse to adapt to your raw data. Instead, they force the massive burden of translation entirely onto you.
Meaning compliance turns into this permanent, suffocating IT bottleneck. Every time a country introduces a new mandate, your IT team has to drop everything, decipher the new government schema, and build a custom translation rule.
And it gets worse.
Oh, great.
Because the sources point out that even if you somehow manage that, you run into something called forced marriages.
Forced marriages. Okay, break that down for us.
So the forced marriage of technology happens when these legacy vendors realize they have massive gaps in their portfolio. They might have a message broker to send the data, but they lack a tax calculation engine to figure out the complex VAT rates.
Ah, I see where this is going.
Yeah, so they attempt to bolt a separate tax engine onto their message broker after the fact. You are merging two entirely different architectures that were born in different eras, coded in different languages, and have entirely different core purposes.
I have to imagine that causes massive performance issues.
Oh, it creates inherent latency and friction. They simply cannot deliver the native, microsecond-level agility you need for true, continuous reconciliation when the systems are just bolted together as an afterthought.
Which explains why some companies just give up on external vendors entirely.
Yeah.
Right? They just try to build legacy solutions directly inside their own ERP, their core enterprise resource planning software. Or they just buy local add-ons just to check the immediate compliance box for whatever country is currently knocking on their door.
Which is incredibly dangerous for data consolidation. Let's say you have an add-on for France, another for Mexico, another for India.
Right.
These add-ons force your enterprise to implement separate configurations, complex integrations, and custom database tables for every single country you operate in. It fragments your workflows.
So your data is just scattered everywhere.
Exactly. And more importantly, it locks the business into a single ERP environment. If your multinational subsidiaries use different versions of software, or heaven forbid, entirely different brands of ERPs, it becomes mathematically impossible to consolidate that data into a single global cockpit.
Okay, let's take a breath and pivot here, because the picture we've painted so far is, frankly, pretty bleak.
It's not great.
Yeah. If your only goal is to blindly fire an invoice at a tax authority to avoid a fine, sure, buy a digital postman or a Frankenstein ERP add-on. But if you want to future-proof your global finance operations, the sources argue you need a radical paradigm shift. You have to move to a technology-first approach.
Yes, and the defining characteristic of a next-generation technology-first compliance ecosystem is the complete rejection of country-specific ERP customization.
So no more duct taping add-ons.
None. Visionary architectures are entirely rewriting the rules through a centralized no-code philosophy driven by a single unified engine.
And the secret sauce to making this work is something the sources call the canonical data model. Walk us through how that actually works in practice, because honestly, on the surface, it sounds like tech buzzword bingo.
Fair enough. Let's break it down. Canonical simply means a standard, accepted rule or form. Instead of demanding that an IT team pre-format complex XML files for 50 different countries, the new paradigm operates on a radically simple premise. Raw data is king.
Well, wait, hold on. Let me push back here. Raw data is inherently messy.
Very messy, yeah.
Every company's system outputs raw data differently. One system writes the date as month, day, year. Another writes day, month, year. How does a single cloud engine make sense of thousands of different data languages without forcing the IT team to clean it up first?
That is the absolute brilliance of the canonical data model. The enterprise's ERP system just outputs standard raw transactional data in whatever format it naturally uses. That messy raw data is captured by a cloud-native engine and mapped exactly once into the centralized canonical format.
Oh, I get it. So the engine acts as a universal translator.
Yes. Once the transaction is standardized in that central model, it becomes the single source of transactional truth.
So from that one master format, the platform can then automatically translate, enrich, and dispatch the data into whatever local format the regional tax authority demands.
Precisely. It doesn't matter if the government wants an e-invoice format for Italy, a real-time e-reporting schema for France, or what is known as a a standard audit file for tax. It's a massive standardized file containing all accounting entries that many European countries require for audits. The central engine handles the translation into all those formats autonomously.
The efficiency of map once, reuse globally is mind-blowing. When a government changes its regulations, the platform provider updates the translation logic in the cloud, and that update pushes globally.
Right, without you lifting a finger.
The sources note this philosophy reduces implementation times for subsequent countries by up to 80%. But let me play devil's advocate again here.
Go for it.
If a global enterprise is just throwing all its raw data at a single cloud engine, doesn't a centralized system create a massive single point of failure? I mean, if tax laws change overnight in 3 different jurisdictions, doesn't that bottleneck the entire global operation?
It is a totally valid concern, and it is exactly why you cannot use legacy tech for this. This is where modern cloud-native architecture really proves its worth, because the compliance logic is maintained centrally by the platform provider, and not by the company's internal IT team. Regulatory updates are proactive and automated.
So the platform provider takes the hit.
Exactly. The platform absorbs the regulatory shock. The enterprise's internal IT team doesn't have to rewrite a single line of code in their core systems.
Which brings us to a critical imperative for modern CIOs, which is protecting what the industry calls the clean core.
The clean core, yes.
When we talk about tax compliance today, we really cannot separate it from a company's broader IT strategy, especially for massive enterprises migrating to modern cloud environments like SAP S/4HANA or advanced Oracle ecosystems.
The clean core concept is vital here. Every time you inject a custom table, a local add-on, or a specific piece of integration code into your ERP to handle a local tax law, you are creating technical debt.
Explain the mechanism of that. Why does technical debt matter to a CFO?
Technical debt essentially means you are taking a shortcut now that you will have to pay for later. When you heavily customize an ERP, it becomes sluggish. More importantly, when SAP or Oracle releases a major software upgrade, all those custom patches you built for global tax compliance might just break.
Oh, wow.
Yeah, it drastically complicates upgrades and increases operational costs. By leveraging a technology-first approach and operating the compliance layer strictly outside the core ERP in the cloud, you protect your most critical IT assets.
The heavy lifting, the data formatting, the validation, the complex regulatory logic, all of that happens externally on a dedicated, scalable platform, meaning your core ERP remains completely pristine.
Exactly, a clean core.
No massive re-implementation projects, no unexpected system downtime, just because a country changed a tax rule. Okay, so we've got the raw data safely standardized in the cloud, well outside the ERP. This is where the deep dive takes a fascinating turn. We step beyond just transmitting documents and unlock the power of embedded artificial intelligence.
This represents a monumental shift in the day-to-day reality of finance teams. Let's look at the legacy world first. You submit an invoice. If it fails the government's validation, maybe you use the wrong tax code. You might wait days to receive a rejection.
And when you do, it is usually a cryptic technical error string.
Always. Resolving it requires submitting a ticket to your IT department.
So someone in accounts payable has to wait 3 days for an IT tech to figure out why an invoice in Spain was rejected, which holds up payment and messes up the cash flow.
But in the new paradigm, we introduce real-time pre-submission validation powered by purpose-built AI. Before an invoice is ever transmitted to a government portal, embedded AI intercepts the transaction.
In real time.
In milliseconds. It validates the raw data against country-specific tax schemas. It performs anomaly detection, instantly identifying missing VAT numbers, illogical tax codes, or mathematical misalignments.
It even executes real-time e-sanction checks. How does it manage to do that instantaneously?
Well, the AI uses APIs to instantly verify the buyer and supplier information on the invoice against global blacklists and databases like VIES.
The VIES.
What's that?
It's the VAT Information Exchange System. It's the European database that tracks registered VAT numbers. It cross-references all of this in the blink of an eye. This ensures you do not inadvertently conduct business with restricted, sanctioned, or fraudulent entities.
Which is a massive corporate compliance risk that usually requires a completely separate software solution.
Exactly.
And the most impressive part is what happens when the AI actually catches an error. It doesn't just block the transaction and spit out a cryptic 404 error code. The platform uses conversational AI.
Right, it talks to you. Yeah. The user in the finance department gets a clear, plain language notification. They can actually chat with the AI to understand why the tax code is wrong and resolve the issue themselves right there on the screen. They completely bypass the IT help desk.
By catching these errors early and empowering the actual finance user to fix them, businesses prevent post-submission delays. They eliminate the need for manual invoice cancellations, and they severely reduce the volume of credit notes.
That's huge.
Plus, the same intelligent platform powers smart PDF capture. The AI can ingest unstructured PDF invoices from suppliers, classify them, extract the data, and seamlessly integrate it with accounts payable workflows for full financial automation.
So what does this all mean for the broader company culture? It completely redefines the corporate dynamic. It transforms the IT help desk from being this dreaded, overworked bottleneck for tax issues into an empowered finance department that handles anomalies intuitively. Finance actually controls finance again.
If we connect this to the bigger picture, catching these errors in real-time milliseconds naturally leads us to the ultimate vision for the modern CFO. We're talking about fixing the notoriously painful record-to-report, or R2R, workflow.
Ah, the month-end nightmare. For anyone who hasn't lived through it, a record-to-report is the entire process of collecting, processing, and delivering relevant, timely, and accurate financial information.
And historically, tax compliance, invoicing, and financial reconciliation have lived in completely separate silos.
Totally isolated.
Yeah.
So at the end of the month, finance teams are extracting data from a dozen different systems, dumping it all into massive Excel spreadsheets, and spending weeks trying to reconcile e-invoices with delivery reports, bank payments, and VAT declarations.
It is a totally reactive process. It suffers from a complete absence of real-time analytics, and it is, highly prone to human error.
Okay, here's where it gets really interesting. Think about it like this. The legacy month-end spreadsheet scramble is basically performing a delayed autopsy on a company's finances.
A delayed autopsy, wow.
Yeah, you are just dissecting what already happened, weeks too late to change anything.
Yeah.
But continuous reconciliation, powered by this transaction-level truth we've been talking about, that is like wearing a real-time financial fitness tracker.
That is a perfect analogy. Because the visionary tech platform holds the raw e-invoice data at the exact millisecond it is cleared by the government, it can execute continuous auto-reconciliation. The system's intelligence layer automatically cross-references those issued e-invoices with incoming payment data from the bank and the internal ledgers in the ERP.
Meaning it instantly flags discrepancies.
Instantly. If an invoice was for $10,000 but the incoming payment was for $9,800, the system catches the discrepancy in net amounts or VAT calculations immediately.
Incredible.
It automates the preparation of VAT filings, ensuring that the VAT you declare to the government at the end of the quarter perfectly matches the granular e-invoices that were already cleared by that same government.
The strategic value of this is huge. Executives no longer have to wait for the month-end close to understand their global tax liabilities or cash flow bottlenecks. They have access to dynamic, real-time executive dashboards.
Right at their fingertips.
Yeah, in a single view, a stakeholder can log in and see total invoiced amounts, exact VAT distributions broken down by tax category, document success rates across global networks, and even processing risk indices across dozens of jurisdictions.
This unified digital platform merges enterprise-grade technology with global VAT capabilities. It automates compliance, e-invoicing, cross-border payments, and VAT reclaim, all in one highly secure environment. The time and cost savings from eliminating that manual month-end autopsy are staggering.
It shifts the global finance team's entire focus. They stop being manual data crunchers playing matchmaker in Excel, and they start driving strategic business growth based on real-time insights.
Which brings us back to the stark choices C-level executives and global IT leaders have to make today. The sources make it undeniably clear global tax mandates are accelerating. The regulatory landscape is literally rewriting the rules of global commerce.
And as a listener, as a leader, you really have a final choice to make. If you look at this as just a legal hurdle, if you just want the emissions sticker for your car, you are going to buy a very expensive digital postman.
And pay the price later.
Absolutely. You will endure endless consulting fees every time a law changes. You will clutter your pristine ERP with technical debt, and you'll be left with fragmented data that provides zero strategic value. But if you recognize this global mandate storm as a catalyst, you adopt a technology-first platform.
You leverage your own raw data. You utilize the canonical data model to map it once. You maintain a clean core architecture to protect your foundational IT. And you deploy AI-driven automation to catch errors before they happen.
Proactive instead of reactive.
Exactly. You eliminate manual record-to-report processes. Ultimately, you turn compliance from a burdensome cost center into a strategic engine of continuous financial intelligence.
This deep dive really isn't just about corporate tax. It is a masterclass in how regulatory forced hands can drive incredible leaps in enterprise intelligence and data utilization. You are securing your enterprise with proactive risk detection, all because the government forced you to digitize your invoices.
It is about using the mandate to build a fundamentally better, more agile business.
Exactly. And it leaves us with something pretty wild to think about. This raises an important question for you to mull over. If artificial intelligence can now autonomously validate, reconcile, and file global taxes across dozens of varying jurisdictions in real-time milliseconds without any human intervention, will the traditional concept of a financial year or a month-end close eventually become completely obsolete?
That's a fascinating thought.
I mean, if every transaction is instantly audited and settled, how will that fundamentally change how human beings value, trade, and manage businesses day to day? It's like we said at the start. You didn't just get the emissions sticker. You drove out with an engine running on sunlight.